Silver just went from $18 an ounce to over $90 in the last few years. It became the third best performing major asset class globally. And 2 weeks ago, China announced they're putting export licenses on it. Most people think this is just about commodity prices. It's not. This is about who gets to build the future and who has to beg permission. Because silver isn't money anymore. It's something way more valuable. It's the material you can't make solar panels, electric cars, AI data centers, or missile guidance systems without. And China just said they're going to decide who gets access to it and who doesn't. Here's what I'm going to walk you through. First, how silver markets actually work and why most of what you think you know about price discovery is wrong. Second, why China's move isn't a ban, but something way smarter that most analysts are completely missing. Third, what happened in the 1930s, the last time someone weaponized silver against China, and why that story explains everything happening right now. And fourth, what this means for anyone who thinks markets are free, supply chains are stable, or that the US dollar system is going to keep running the way it has for the last 50 years. Here's a simple question. How do you know what silver is worth right now? You probably think the answer is markets, right? Price discovery, supply meets demand, except there's a problem. There are two silver markets that matter. One is COMEX, the big futures exchange in the US. That's where most of the world's silver price gets set. The other is Shanghai. And those two markets just split apart in a way that should make you very uncomfortable. COMEX is a futures market. Most of the people trading there are miners hedging future production, manufacturers locking in supply costs, or traders speculating on price moves. The actual physical silver sitting in COMEX-approved vaults gets divided into two piles. Eligible silver, which just means someone owns it and is storing it there, but it's not for sale. And registered silver, which is available for delivery if someone actually wants to settle a futures contract with real metal instead of cash. Right now, COMEX has about 120 to 130 million ounces of registered silver. That's the metal that's actually available if you want delivery. Annual global demand is about 1.1 billion ounces. So COMEX has enough registered silver to cover about 10% of 1 year's demand. If every contract holder suddenly wanted physical delivery at the same time, the system would collapse. It's not designed for that. It's designed for paper settlement. Roll the contract forward, cash out, nobody actually takes the metal home. That works fine as long as everybody plays along. But here's where it gets interesting. On December 24th, silver closed at $78 an ounce in Shanghai. At the exact same time, COMEX silver closed at $72. That's a $6 gap. Historically, the premium between those two markets is usually less than $1. Sometimes it hits $2. But $6? And it held for hours during the holiday trading lull when liquidity was thin and nobody was around to arbitrage it away? That gap tells you something is broken. Because normally, when you see a price difference like that, arbitrage traders step in instantly. They buy the cheaper silver on COMEX, ship it to Shanghai, sell it for more, pocket the spread. The prices converge. It's automatic. It's what keeps global markets linked. But when a $6 gap holds, it means the physical metal isn't moving. It means arbitrage isn't working. And that usually means one thing. Physical supply is getting constrained. Shanghai prices reflect the cost of actual deliverable silver inside China. That's the metal manufacturers need to build solar panels and semiconductors and military electronics. COMEX prices, by comparison, reflect a financialized market where most contracts never turn into metal. They settle in cash. Under normal conditions, those two systems stay tightly linked. When they split, it's a signal. The physical world and the paper world are divorcing. And the physical world is repricing higher because it's getting harder to source real metal. This chart that tracks total silver in COMEX vaults, both eligible and registered, shows a clear trend. Silver has been flowing out of Western vaults for years. It's not building up, it's draining. And when registered inventory gets tight, that's exactly when physical silver starts trading at a premium to paper. It's like China's market is forcing the Western market to wake up and reprice reality. So why is this happening now? There's a pattern most people miss because they think about commodities in isolation. China's been playing a much longer game, and it starts with gold. For the last 2 decades, China has been publicly accumulating as much gold as they can buy. They built the Shanghai Gold Exchange into one of the largest in the world. They're expanding what some analysts call the Gold Corridor, a network of gold storage and trading infrastructure that runs through countries aligned with China's economic sphere. They're pushing Basel, 3 standards that let gold be used as Tier 1 collateral for loans. All of this is about one thing: rebuilding trust in money outside the US dollar system. Gold is the trust anchor. It's the reserve asset. If you want a monetary system that isn't controlled by Washington, you back it with something Washington can't print. That's gold. But silver plays a completely different role in this story. Silver isn't about trust. Silver is about control, because silver is the material you absolutely need to make the modern world work. And when silver gets expensive, industries don't stop buying it. They can't. They don't have substitutes. There's a theory that's been circulating in commodity circles for decades. It says that gold and silver prices have been deliberately suppressed to keep them cheap for as long as possible. I'm not here to argue whether that's true. What I will say is this: if you were running an industrial economy and you needed a critical material for electronics, energy infrastructure, defense systems, and AI data centers, you would want that material to be cheap. You would want supply to be abundant and available, and you would not want a rival power to control access to it. China now controls most of the refining and processing infrastructure for silver. Even if the metal is mined in Mexico or Peru or Australia, it probably passes through Chinese facilities before it becomes usable. And starting January 1st of this year, China reclassified silver as a dual-use material. That means it can be used for civilian purposes and military or strategic purposes. And once something gets that label, exports require government approval. Now you might be thinking, isn't that just a ban? No. And this is where it gets really smart. If China announced an outright ban on silver exports, that would trigger immediate backlash. The US government would respond. Other countries would scramble to build alternative supply chains. It would force the world to react. But by reclassifying silver as strategically important and requiring export licenses, China can say on paper, we're not banning anything. We're just regulating something critical to national security. In practice, the licensing requirements are written so narrowly that almost nobody qualifies. Even the producers who do qualify have to wait for approvals that are entirely discretionary. The government can delay, deny, or approve based on whatever criteria they want. It's gatekeeping disguised as regulation. And it's not the first time China's done this. Over the last decade, they ran the exact same playbook with rare earth elements. Today, China controls roughly 80 to 90% of global rare earth refining. Rare earths are essential for electric motors, wind turbines, precision-guided weapons, advanced electronics. In the early 2010s, China reclassified them as strategic. They imposed export quotas and licensing rules. Prices spiked. Governments panicked. The US, Europe, and Japan all realized they had a problem. But rebuilding rare earth refining capacity outside of China wasn't a 6-month project. In many cases, it took over a decade, and it's still not fully solved. What we're seeing with silver now is the same strategic framework applied to a much more widely used material. Silver isn't a specialty rare earth that only goes into a few niche applications. It's in everything: solar panels, EV batteries, 5G infrastructure, medical devices, satellites, water purification. And the problem for the West is that silver supply doesn't respond to price the way normal commodities do. Roughly 70 to 80% of silver production is a byproduct of mining other metals: copper, lead, zinc. That means even if silver prices double, you don't automatically get more silver unless companies are also mining more of those base metals. Economists call this inelastic supply. Let me give you an analogy. If coffee prices double tomorrow, some people would drink less coffee. That's elastic. Demand responds to price. But if insulin prices doubled, people with diabetes would still buy it. They don't have a choice. That's inelastic. Silver demand is inelastic because industries that need it don't have good substitutes. And silver supply is inelastic because most of it comes as a side effect of mining other things. So when China restricts exports and Shanghai prices start running ahead of COMEX, you get a scenario where the physical market is effectively saying the paper market is wrong. The real price of guaranteed deliverable silver is higher than what futures traders think it is. China set a January 1st start date for the new export licensing rules. And in the months leading up to that date, Chinese buyers were locking in as much supply as they could. Forward contracts, long-term deals, strategic stockpiling. Meanwhile, foreign buyers who assumed the global silver market would just keep functioning the way it always had are now sitting on the other side of a new reality. They have to ask permission, and the answer might be no. Now, here's where the story gets historical, because this isn't the first time someone used silver as a geopolitical weapon. And the last time it happened, it was used against China. For most of its modern history, before the 20th century, China's economy ran on silver. Taxes were paid in silver, major transactions were settled in silver. Trade balances were denominated in silver by weight, not by face value. Silver was China's money. And because of that, China became one of the biggest consumers of silver the world has ever seen. From the 1500s through the 1800s, massive amounts of silver flowed into China. If you wanted access to Chinese goods, because China was the factory of the world even back then, you paid in silver. It stabilized their economy. It stabilized prices, wages, tax revenues. It worked until it didn't, because there was one major vulnerability. China didn't control the global supply of silver. And in 1934, the United States passed the Silver Purchase Act. The law forced the US government to buy huge quantities of silver, and that drove the global price of silver way up. For a country running on a silver-based monetary system, that was catastrophic. As silver prices rose, silver was pulled out of China. The money supply contracted. Prices started falling. Deflation set in. And deflation sounds good at first. Oh, prices are going down? That's great. Except it's not. Because when people expect prices to keep falling, they stop spending. They stop investing. Businesses stop hiring. The economy starts to eat itself. If you know the thing you want to buy is going to be cheaper next month, why buy it today? Multiply that behavior across millions of people and you get an economic collapse. In 1935, China was forced to abandon the silver standard and move to a paper currency. Not because silver failed as money, but because China learned a lesson it never forgot. If your economy depends on a material you do not control, other countries can weaponize it against you. Fast forward 90 years. China is doing to the West exactly what the West did to them. Except this time, it's not about collapsing a monetary system. It's about controlling access to a material that every modern economy needs to function. Solar buildouts, EV production, AI infrastructure, defense systems, all of it requires silver, and all of it now requires a conversation with Beijing. You might think the solution is simple. Just mine more silver somewhere else. Build refineries outside China. Except that takes years. Rare earth refining took over a decade to partially reshore, and it's still not done. Silver refining infrastructure doesn't get built overnight. It requires capital, permitting, environmental approvals, technical expertise, and time. And in the meantime, the factories that need silver today don't get to pause production and wait. They have to buy at whatever price the market sets. And if the only market with physical metal available is Shanghai, then Shanghai sets the price. This brings me to a broader point about how silver behaves. For most of its history, silver does nothing. It sits flat for years, sometimes decades. Then something changes in the supply and demand structure, and silver moves violently. In the late 1960s and 70s, silver doubled multiple times. In 1979 into 1980, it went from around $6 an ounce to over $50 in just over a year. Then it crashed. Then it did nothing again for a long time. Silver doesn't move like stocks or bonds. When stocks get expensive, investors can wait. When bonds look unattractive, money rotates into other assets. But when silver becomes hard to source, factories can't wait. Governments can't wait. They need the metal, so the price spikes fast. And that's when speculators pile in. Momentum traders, retail investors who see a chart going vertical and want in. That's the speculative phase. And after every speculative spike, silver corrects hard. Not because the world suddenly needs less of it, but because the hot money that chased the momentum exits just as fast as it entered. I have no idea where we are in that cycle right now. I don't know if silver at $90 is the beginning of a fundamental repricing or the end of a speculative run that's about to reverse. Nobody knows. Some people say it's finally catching up to reality. Other people say, be careful, you're buying the top. I don't make price predictions. What I do know is that when silver corrections happen, that capital looks for the next thing. Sometimes it's equities. Sometimes it's energy. Sometimes it's emerging markets. In recent years, it's been things like Bitcoin. We've had a run in gold. We've had a run in silver. We've had a run in AI-related tech stocks. At some point, that capital rotates. The question is where it goes next and what that means for the broader market structure. But the most interesting part of this story isn't really about silver at all. It's about leverage. Not financial leverage, geopolitical leverage. Because silver sits at the intersection of money, energy, technology, industry, and national security. And whoever controls that intersection controls a choke point. China learned that lesson the hard way 100 years ago. Today, they're applying it in reverse. They're building trust in an alternative monetary system using gold. They're decentralizing custody of that gold, using infrastructure like the gold corridor, and they're locking down the materials that the modern world can't function without. Silver, rare earths, refining capacity. If you control those things, you don't just influence price. You influence who gets to build, who has to wait, and who has to come to you for financing. That's leverage. And in a world that's moving away from cooperation and toward what economists call multipolarity, leverage is the most valuable currency. It's not one country making all the rules anymore. It's not just the US controlling the reserve currency and setting terms for everyone else. It's a fragmented system where multiple powers have veto authority over critical supply chains. And silver is one small piece of that larger shift. This isn't a conspiracy. It's just incentives. China has an incentive to secure strategic materials. The US has an incentive to rebuild domestic supply chains. Europe has an incentive to not get caught in the middle. Every player is optimizing for their own position. And the result is a system that's way less stable and way more expensive than the one we had for the last 50 years. Here's what that means practically. 1, if you're invested in markets, understand that commodity shocks are a feature of this new system, not a bug. Supply chain fragility isn't going away. It's getting worse. 2, the idea that markets are free and prices are discovered through open competition is increasingly a fiction. Prices are being set by export licenses, strategic stockpiles, and government approvals. 3, if you think this is just about silver, you're missing the point. This is about every critical material. Lithium, cobalt, rare earths, semiconductors. The entire stack of stuff you need to build a modern economy is being weaponized. So what do you do with that information? You can try to trade it. Good luck timing a commodity supercycle. You can try to avoid it. Also good luck, because this affects everything. Or you can build a portfolio that assumes the world is going to be more volatile, more fragmented, and more expensive than it used to be. That means real assets. That means diversification across geographies. That means not assuming the next 30 years will look like the last 30. Lazy investing built more fortune than crypto memes. I still believe that. Boring index funds, long time horizons, compounding returns, that's how wealth gets built. But lazy doesn't mean blind. It means understanding the systems you're operating in and not pretending they're stable when they're not. The silver market just told you something important. The paper price and the physical price are splitting. The West's assumption that commodities will always be available at market prices is breaking. And the country that controls refining infrastructure is turning that control into geopolitical leverage. You don't have to buy silver. You don't have to panic. But you do have to update your model of how the world works. Because the model where supply chains are global, prices are transparent, and markets are efficient just got a lot less accurate.